The government wants to build over 200,000 homes a year. Now, over the last 12 months, they only built 162,000. That's a 32% shortfall. This massive goal sounds great, but in this episode, I'm going to unpack why the likelihood of this happening is close to 0%. I'm going to explain this using data on what's actually happening, why it's happening as the causes, and even more info about completion rates versus what's being told out there. I'm Arjun Paliwal. Let's go. Firstly, when diving into this, let's break down this annual target a little bit more, right? When you've got this annual target, it's easy to say 1.2 million homes is what we need. But it's not going to happen because firstly, when you're looking at that in that time frame, you actually need either A, more completions or more time. Why I say this is homes, if you, for example, look at it, could be up to 12 months of completion time, end to end, some longer and some even quicker, but not that much. Townhouses with multi-dwellings attached to it could be 15 to 24 months. And then actual constructions of large dwellings like unit blocks and towers could be up to 2 years or 2 to 4 years, depending on the building. So what you're seeing here is that, yeah, sure, 1.2 million homes, but even the word homes has to be defined as homes, townhouses, or units. Because when you break that down, the variance in the time frame to complete these things can range from months to a year to multiple years. So even if you say they're going to be approved during that time frame, they might not be built over the years ahead to reach that target. Now, those time frames are evidenced by this chart coming up, which is on ABS building activity. And you can clearly see the new apartments are taking up to 30 months in some cases, and townhouses 15 months, and new houses up to 12 months. You'll also notice that they all increased in terms of the townhouses and houses after 2020, the pandemic. But funnily enough, they actually decreased in time it takes to build for the newer shiny apartments or the larger building apartments from 2020 to 2023. That trended down from just over 30 months to about 28 months, which is a good improvement. Now, to achieve 1.2 million dwellings by say 2029, Australia actually needs to build 240,000 properties in 2024 alone. Now, when looking at the data from last year, there was only about 162,000 built, which means there's a shortfall of about 32%, meaning it's unlikely that we're suddenly going to pull it out of the bag and just say a 32% increase happens to finish 2024. Now, if we distribute the target and we start looking at this target and go, hey, can we make it a fair distribution by population? Which areas across the country are probably on track to hit their target if you're breaking it down by population distribution? And really, as sad as it sounds right now, it's only one. And the only area is ACT. It's the only state or territory that might actually be on track to hit their first year target if you distributed that national target down to a population level. Now, among the rest of the states, I've got some other interesting data. If you were to say, okay, ACT is up there in first place, who else is there that's getting close to that target? Well, Victoria comes second, where it's only 16% below that shortfall. Northern Territory did the worst, with 84% below that shortfall. And New South Wales, which has the highest population concentration in the country, was actually a 44% shortfall. So it's not looking pretty for some of our bigger states in New South Wales. And from our smaller states, even though geographically they might be large as a location, being Northern Territory, from a population and space available, they still came off pretty bad with only 84% below that shortfall. So it's a big drop when it comes to all the governments and what they're doing, with ACT probably only on track to reach that goal that was set. Now, if you break that down one step further, it's only 15% of SA3s that actually make their target, which means 85% won't even hit that target this year based on their forecasts of building completions for that metric that was set of 240,000 homes. Now, if we're taking that metric in the same population spread and moving from capital centers to regional centers, which regional centers are doing okay or well from that building perspective to meet that target? So if we're looking at some areas doing well, it's Surfers Paradise in Broadbeach, so that's the Gold Coast region, Caloundra in the Sunshine Coast, Geelong, Maitland, and Hervey Bay. So they're all the regions from a population distribution to the approvals in pipeline and completions coming through. They're the regions that are doing a little bit better and lifting above their weight when it comes to this national target if you distribute it by population. If you actually now go the opposite, where are the areas in the most acute shortfall in comparison to this target by their local population? Now, those are areas of Gladstone, down 76% from a shortfall, Mackay, down 75%, Bathurst down 73%, and Port Stephens down 69%. So they're at the absolute bottom of that population distribution to supply incoming. So it's clear to show that there are many parts of the country, 15%, that are getting it there and are likely to hit it, but 85% of the SA3 regions are unlikely to hit this goal. Now, those were my opinions of using InvestorKit research here to say, based on the completions and things that are to date, alongside the actual population distribution of what's likely to happen, I shared that majority of the country showing signs that it's not likely to meet this goal. But let's not just take my research here at InvestorKit. Let's also take the research of the National Housing Supply and Affordability Council. They're predicting that over that whole period, we're only likely to hit 1,040,000 dwellings in comparison to the 1.2 million dwellings target that's there. So there's still a bit of a shortfall in play just from that forecast alone. Now, when you're looking at some of the actual causes, when you're looking at this problem that's in play, they're down to 3 causes. The first cause is elevated construction costs, things like material or labor. Now, I know in recent times they have been improving, but that flow onto the end consumer just isn't showing as it should be. So that key here of elevated construction costs is the first cause of the 3 that have come to create this dwelling deficiency. The second one is reduced land supply and increased land prices. We've actually gone through a land price boom over the last 4 years in Australia. So with that reduced supply combined with the land price boom, and if on top of that, you're actually chucking on extra prices to build, the buy-in price for people is much more difficult, and even developers to actually go and soak up and purchase that stock from the land prices that have increased have become more difficult as well. So increased prices, whilst you think it might be a good thing, it slows down the system as well, because you now have more expensive prices to buy in to create stock, but you also have more expensive prices for the everyday consumer to actually go and buy as well, which reduces the rate of supply rather than it being cheaper and more available at higher frequency. The third and final part is increased insolvencies in the construction sector. So this is a dangerous part because construction doesn't happen overnight. Unlike an established property, you don't just buy it off the shelf that's sitting there on the domains of real estate and settle within 28, 30, or even 42 to 60 days. The key thing is construction takes a lot of trust in the builder, a lot of belief that they'll pull through, and time. Now, what's dangerous here is some of Australia's strongest companies in the past, or larger builders, have been proven to be weak in times like today. The insolvencies hitting Australia have given such low confidence to the consumer that many of those consumers that were looking at building have now jumped into the established market just because they don't feel like they can trust a builder to deliver end to end. It's a heartbreak for people when they go down such an important project for their home or an investment and they have that company go bust, wondering whether they'll get their money back, wondering whether they'll ever be able to complete it to the way they wanted to. And so as a result, people are just going to the market where houses are established and looking to invest that money for a property there, or looking to buy a home that they can live in and do renovations down the track so the property isn't taken away from them, or they aren't stuck in this period where they actually have to go and figure out how they can get their builder to finish it off. This is huge. Don't underestimate that, because that negative sentiment is making a big factor on decisions. Now, if you look at all 3 together and you imagine construction wasn't as expensive, the land prices weren't booming so people could get in both from a developer supply and also from a consumer buying. And then lastly, you ended up having great confidence in the industry with many people proving to build with lack of insolvencies as well happening, so the industry doesn't have that negative sentiment. I can assure you more houses would have been built. Now, if we zone into each of these 3 causes just that little bit deeper, let's start off with the elevated levels of construction. So in this chart here, we're going to pull up chart 3.14, which shows dwelling construction costs, and 3.15, which shows construction output prices. And for those maybe who are not tuning into the video, jump on the YouTube and search up InvestorKit. And that's where you'll see our channel. You'll be able to hit subscribe and see the video with charts like this. But if you're listening, I'm going to do my best to give you the actual percentage movements so you can hear what's happening. So the first part is the cost of building a new house is around 40% above 2020 levels. And if you look at the greater increase, it's more than 20% above the broader increases in prices across Australia. So that's huge. While the construction sector and all these cost pressures that have been there have actually been really heavy in the housing construction even more relevant to other construction industries, right? Because construction, it just isn't for houses, it's for others. So it's been a deeper shortage and a deeper pain point for houses in particular. Now, the next chart I want to show you is from a cost perspective, and this is 3.16 for building materials price growth, because remember, there's labor and there's overall construction prices, but you've got to break it down to the materials. And what's interesting to see is concrete, cement and sand, electrical equipment, installed gas and electrical appliances have all seen their prices, even to today, keep increasing. Whereas if you look at things like steel and timber, they've actually been heavily declining since about December of 2021. So we can see that firstly, steel and timber heavily boomed from 2020 going up to 2021 and parts of 22. But then in the later parts of 22 and 23, steel and timber have really come off, while some of the other costs have picked up. Then if you go to the next part, we're talking chart 3.17, shortages in skilled labor. We can see increasing labor costs have come into the mix as well. So things like long-term labor shortages in the residential building sector do still persist, and things like competition for specific skills from large government infrastructure programs and private industry, all of that has added to this shortage because there's more competition from those other industries being in the mix as well. So Jobs and Skills Australia had a skilled labor shortage index for all type of skills laborers, and that index has scored between 75 to 125% higher, depending on the category, from this time today to 5 years ago, which is pre-COVID, which clearly shows that we are having an issue from all sorts. Some materials increasing in costs and others declining, like the steel and timber. Other things like shortages in labor and skilled labor in particular, down 75 to 125% from this time 5 years ago. Lastly, the overall costs are now 40% above pre-COVID construction costs. So this is huge. That's cause one going deeper. Now, obviously, the impacts of COVID have added to that or been a big disruptor in this, with global supply chains impacted and job and economy shifts all over the place. At cause number 2, I talked about pricing in the land market and also the release of land in the land market. Now, with cause number 2, here's some interesting stats to look at. The current flows of residential lots in Australia are 33% below the 10-year average. And so this is a big shift, right? Because that number is huge, over 33%, not a small 5 or 10%. The second part is the number of residential greenfield lots, which is new land that's mainly used to build detached houses, that are released for development nationally fell 26% in 2023 to only 36,500 lots in the greenfield space. This is a concerning number because you've got a reduction in greenfield lots meeting the market, but you've also got an overall reduction in residential lots over the 10-year average. And what's important to see is if that build cost is one part, which is point number 1 I raised, if on top of that you're seeing land lots not make it to the market, then you've got a double problem here. Not only have you got the issues of the cost of construction, but you've also got the issues of the land releases and the lots not coming out to market as much when you're seeing the fall over the 10-year average by 33%. Cause number 3 is me going into the actual profit margins and the business of building, because this is impacting it through the insolvencies being made. And if you look at the combination of things like fixed price contracts, for example, contracts from a few years ago where they gave the client a cost, the builder gave the client a cost, and you see the costs surge up for that builder, but then the cost for the consumer is the same because of the fixed prices, the builder's caught up in a big issue where they're not making money and they're losing money on selling you that product. Crazy, right? Hey, I'm going to buy this building off someone, they're going to do it all for me, and they're going to lose money while doing it. Very rare does that happen, but you're now seeing that happen in play. And so as a result, these fixed price contracts have chewed away at the margins for many builders over the last 2 years. That's come down a lot, but still was at high numbers, which created many insolvencies in play. Now, this insolvency review, when you look at chart 3.23, which is going into the insolvencies, you can see a clear spike when it comes to the construction industry. It's the deepest spike here. Hospitality and arts was another spike. Retail and wholesale is spiking too. So it's clear that the economy is turning into a weaker point when you see all the interest rate increases and the GDP shifts, but it's massive to see the insolvencies spike up like that in the construction space. Now you are looking at that chart showing a big rise up. the levels are starting to normalize again. Now, this is from RBA's points raised in 2024, where they've said that industry stakeholders have indicated that insolvency rates have started reverting to more typical levels as material costs have started to normalize. This was evidenced by me talking about steel and timber dropping a fair bit. There were still some other things like cement and sand, electrical appliances rising, but with steel and cement dropping, that makes a big weighting of the overall building, right? Steel and timber, sorry. And so when you're looking at this, yes, the insolvencies might be starting to stabilize again. The problem, though, is it's doubled down with media sentiment. So the data points are starting to stabilize, but the media sentiment isn't. And that, as a result, has caused a lot of pain in consumers' minds about, hey, maybe the building might not go through, maybe it might not finish up. And because of that, this is now causing a thought that buyers do not feel that construction is the best way to go. So insolvencies rising, prices rising, media sentiment, and not enough lots coming through is all coming together to create this low period of building approvals, which means this 1.2 million homes target is just not going to happen. It's not even our data. It's not even the interpretation of all of this data. It's actually also the national housing authorities that are in different councils and different industry groups that are all saying the same, that we're way behind where we should be. So this is important to consider, not just from this topic of is it going to happen or not from the homes that are there, but it's important to consider that on your own investing journey. If you're aware of building supply, land supply, and the costs that are going up, two things are likely to happen. One is 85% of SA3s across the nation are likely to be undersupplied and not meet this target when you profit distribution, when you do a population distribution. And secondly, when you actually look at this target, that aside, it just simply means we're seeing some building undersupply, which is also leading to increased costs of lots and increased costs of actual construction prices. With those increased construction prices, even when people do build, it's likely the prices outweigh established property by a fair bit, which means there's unintentional price growth happening. It's very rare because this doesn't happen when you look at the charts of the past, where usually building supply keeps a lid on price growth. But over here at the moment, you're starting to see prices increase because of how expensive the construction prices of new homes are. Now, just with the huge reduction in steel and timber prices, I expect the construction price itself to really stabilize. Even with now the global supply chains improving a lot, I think the biggest difference maker will be the release of lots and the subdivisions of them coming back to their 10-year averages. And secondly, media sentiment and consumer sentiment improving with insolvencies shifting. I think interest rates reducing will help a lot of that consumer confidence pick back up, because interest rates increasing have not been healthy for the businesses that need to sell their products. And the media sentiment definitely bashing on the construction industry hasn't helped either. So those are some of those causes flipping over to turn into, the solutions. But right now, it's clear we're not going to meet the 1.2 million target over the years ahead based on the trends that's seen and what's happening right now in the construction industry. Which means you might be insulated in some of the areas you're buying in with building supply through price growth happening with the end product being more expensive, or just not enough making it to the market, and the world will just keep ticking on with an undersupplied area in Australia. So I think this is important to know in your property investing journey, to not get spooked by all the supply that'll come in if you're looking at the research down to the micro. And if you enjoy this episode, click the subscribe button to have more data-driven podcast episodes like this.